All right, welcome back to Death Taxes in this podcast, episode 6. We're here today. We're going to talk about business performance from a management perspective. So obviously there's investors and managers. Investors look at WACC and ROI. We're not going to do that on today's podcast. We'll be doing it at a different time. But today we'll be looking at like management reporting and things like that. And I've got someone who's the best in the business, my man Joe. How you going, mate?
Very good. Welcome back from New Zealand, mate.
Thank you. Yeah, I just got back from holidays. We went to Queenstown, the family, and honestly, it was a great trip. 25 centimeters of snow on the last day, which was absolutely amazing. I got like a little taste of it, so I'm pretty pumped, mate. Like I might have to come to Japan with you solo next year, or is it year after? When you
Probably
go again?
year after.
Yeah.
Well, I want to go next year. You're the one who's having a baby, so
I won't be able to do it. Yeah, not for another year or two. But
welcome back. Happened to be the busiest week of my life.
It's always we always joke that I don't do much work, but then I go away and then everyone starts to realize, hold on a second, this man holds it together.
It's true, mate. It's true.
All right, so I guess like what we're going to chat about today is obviously business performance and how we help as a CFO with all of our clients and what people should be looking at. So I guess like first thing I'll talk about is like budgets, because we just finished everyone's, you know, like new financial year's coming along. So like, what do your clients mostly look at? And then I'll go into some of like what my clients do for budgeting. How do you set the process up? And when do you start it? Do you start it in, what month? April, May? Do you do month to month? What do you do?
Yeah, I think it's good to look at it probably in May when you have a clear picture of last year's performance. I think it's more like you want to do it for new businesses, but when you're really just driving revenue because you have no clients, like it's hard to budget. You really budget on revenue only. Once you're a bit more established, then you're looking at more revenue, cost of goods sold, like your whole P&L and balance sheet.
What do you guys do? Like, do they go line by line? So like, I was going to do this a bit later, but what I might do is I'll go in like, so the different methods of budgeting, like, we know them very well, and I'll go in with my favorite after, but I'll ask you your favorite first. So there's zero base, which is what you were just talking about there, where there's like, brand new business, you got like nothing, no historical data, you don't know how many clients you're going to have. It'd be similar to that Christmas business that was going to come out, like that sort of didn't end up going to fruition, unfortunately. But they like, how did they budget? Because obviously they had methods, so that would be zero based. Correct. They just made up scenarios. Yeah,
so you're starting with how many people do we need to come through the door? How much are we charging per person, just to build up a revenue budget.
So so you start with the cost, right? Like, and then like, so like just on the zero base, you'd be like, all right, this is what the warehouse costs. This is what the rental is, because they're all stuff that you probably got access to. And then you figure out this is how many people we need to come in to break even.
Yeah. Okay, and how much money we're looking to make, and how many do we need per day, and break it right down to the detail.
Yeah. So if you're a brand new business and you're using zero base, it's best to start with your costs. Figure out how much they're going to be, and then figure out from a revenue perspective how many people you're going to have to come through, and then you like, how do you figure out if that's realistic or not?
Yeah, well, I think that's what in this case, like they found like they needed to hit a certain amount, and they just, from the bookings, didn't look like they were going to get there.
Yeah.
So it is difficult in that situation.
It's a bit of a punt, like, because you never know when people are going to.
Well, that's a high capital event, right? But most service businesses, for example, their costs are very low to start with. It's themselves.
Yeah. Right? Like if we look at us, we didn't really have a budget when we started, but it's probably because we do so many. But obviously, like, I think we came out and I was like, if we get 60 grand this year and then we delay paying tax.
When you're a service business, you're really focusing on the revenue, right?
Yeah.
And then you look at the costs as you go and you grow, because your costs are going to get bigger, and then you're looking at your margins and all that kind of stuff. But for a service business who's starting out, you got very low costs. You're really focusing on the revenue budget. How many new businesses, how many new clients do I need? And work out like, how many do I need to sign per month to hit X amount of money for the year, and go from there.
Yeah, so I guess, so that's like a very new business. Then we'll flick straight on to like an established one. And they usually do incremental, which is like, I don't know, you could say a bit lazy, but like they just add a percentage onto their revenue, and they add a percentage onto their costs, and then they just assume that that's sort of how it's going. So you're talking businesses that have been around probably for 10 years, or, you know what I mean?
Yeah, it depends on the industry you're in as well.
Yep.
Because like, for example, one that has recurring income already, they're going to do that. They're going to go, okay, we need 10 grand more per staff member per month or something revenue, and this is how much new business we need, and we focus on new business, and the old stuff is sort of there already.
Yeah.
And then they focus on then they break down their costs. But for example, a recruiter who does perm,
Yeah.
like they're going to look at how many placements each person needs, the average revenue per placement in terms of building up the revenue budget.
Say like a restaurant, you know what I mean? Like, because like obviously restaurants got life cycles, you know, they pop up, they only last for what, 5, 6, 7, 8 years.
Yeah.
So first year you're doing like, you know, your zero base sort of thing, figuring out how many customers you come in. Then like what you get to year 5 and then you just know what the dinners are going to be and all that sort of stuff.
Yeah, you're looking at, with that, they look at it more regularly and they look at like bookings and they look at it per week. Like they're looking at a lot more numbers regularly.
Yeah.
They also know the months that are lower. So that comes into their budget. So it's more cyclical, like April, for example, October, big school holiday ones.
Yeah, so seasonality.
Seasonality in it. Like they get taken into the budget as well. And the good restaurants and the good in that area, they really like decrease their costs, their variable costs during those months. The ones that aren't so good, like they just have a lot of fixed staff and they can't really decrease it. And like they know from history for the last 5 years that in April it's going to be not a great month.
Yeah, yeah.
And that's not going to change because everyone's on school holidays, it's Easter, whatever. Especially, it depends on your location, obviously. So they're going to take that into account in the budget. And they're going to go more in detail per month. And then they're going to look at historical details and amend based on that in their budget. Yeah.
Yeah. So if you're an established business, like you can just do an incremental percentage-based thing, and then I guess when you're looking at budget versus actual, which we'll get into later, then you can start seeing like things that aren't working. I guess the next method is the top down. Now this is my favorite, basically because like revenue minus expenses equals EBIT or profit, right? So if I said, I want to earn $1 million this year, then I can back solve because you're going to get, it's like algebra. You get two, and this is how you actually do top down. Like you just literally get 3 numbers, you figure them out, and then you go do the top down. So like I could say, all right, these are what my expenses are. Like Joe's salary is X amount, Samir's getting paid whatever.
Pretty much 0, mate.
The divvies don't count, but yeah, correct. So Joe's salary is this much. Tack, who we pay for filming, he gets paid this much, and I've got all my expenses. Rent's this much for our office in York Street, and then I say I want to earn $1 million, you know what I mean? And then I can figure out through algebra what the revenue needs to be for me to do that. And then I can go and then I break it down in my head. All right, I need to earn that amount of money. I need to go and find 10 clients a month that are worth this amount of dollars. And then I just get out and start marketing and stuff like that. That's why it's my favorite method. It also is the method that probably gets you like the furthest from the actual result.
I think for a service business, it's the best method.
Top down.
Yeah.
Yeah.
Like, because your real driver is revenue. It's just about getting out there and winning it, and the costs are pretty fixed.
Yeah,
right.
Yeah.
And a lot of businesses are the same, but service businesses especially, like you win more work. Okay, you hire someone else. You win more work, you hire someone else. But that comes from winning it. So like recruiters, lawyers, whatever. Like it's pretty easy to budget that way.
True. So like one off. Like non-recurring revenue businesses, like exactly what you're saying, like recruiters, lawyers, like accountants, we've got recurring revenue, so we could probably even do the incremental. But okay, so like people that are out there trying to win work, like lawyers is a great example, and recruiters the same thing for perm. You know what I mean? Yeah.
They have to hit X amount of jobs per month, and they have to hit a certain amount of revenue to get to the result that they want.
Yeah.
And they need to be tracking, but even recruitment, like, when you win a job now, you might not place them and they might not start for 2 months. So it's and also if you bring in someone, they don't actually generate revenue, you might not generate revenue for 6 months. So you really got to be planning a long way in the future to be able to get to where you want to be for them. Yeah,
okay. That makes sense. So then I guess the last method, which is the bottom up, is that your favorite or?
I don't know. I think depends on the
depends on the industry,
the scenario.
So we'll summarize what industry is best for what method, like as a little summary of what we're talked about. But okay. So bottom up, like I honestly, like I grind my teeth when I'm doing bottom up. It's just like it's so detailed and boring. But like honestly it works. So like I've got a client who could do the incremental method, but he always does bottom up. So like every single line goes through.
Talk to people. What's he do?
Yeah, so he goes through every single line. He goes, so like he's got 4 entities, which are all different businesses. And they're all like the same industry, but they're just different entities, right? With different people that are in there. And he goes through every single line. So I'm talking like 200 lines times 4 businesses because they're all got the same lines. And he goes through and checks, subscriptions. And to be honest, like you're right, it is a really, like it's a good way because he only spends 1 time per year doing it. And he goes through and he finds some subscriptions that they haven't used for a couple of months and he turns them off and saves money. And like, and it's definitely worth the time, but yeah, it's a bit of a grind. So it goes through all of the expenses line by line and then builds them on bottom up. He's like, all right, well, how much is that subscription? And I know exactly what that amount is. I'm going to put that in and, we got this subscription and like that's going to have an increase. Or Luke, what's your fee going to be? Goes through that line and then goes through. So like he does it from a bottom up sort of perspective.
Actually, speaking of subscriptions, because that's the one that gets you, isn't it? Because it comes out of the bank account. I was speaking to a client yesterday about their budget and excuse me. And he said, well, let's just turn off the credit card.
Yeah, I love that, man. I do it once a year with my own personal stuff. Yeah,
let's turn off the credit card. And then the ones that we want to keep, like, we'll sign up to the new credit card.
It turns off eventually. And then you're like, oh, bugger, we better put that back on.
We'll turn that one back on because we actually need it. And all the rest just get turned off automatically without you having to do anything. I thought that was genius.
No, honestly, it's pretty good. I do it with my own personal cards.
I should do that as well.
Yeah, it's definitely worth it.
So, but that is the kind of detail. It will get you ahead later on. But I think that client can do that because like there's a lot. It's an established business. There's like people out there writing revenue and all this kind of stuff, right? And that is his role to do that. But for smaller clients, 1 or 2 owners, I really try to tell them a million times over to focus on revenue.
Yeah,
like it's for that established business, fine, and he has the time and he's getting paid to do that. That's fine. And he's going to make a little bit on it. But the small businesses, 1 or 2 owners, like even our level, like we got to be focusing on revenue.
100%. Yeah, I agree totally with that. That's all we focus on.
Yeah. And then the rest, then you look at your margins, which we'll talk about percentages and stuff. But then you go from there. Yeah.
Yeah, okay. No, so that like answers one of the questions I was going to ask, like do all your clients budget? But basically,
not all of them. I mean, they probably should, but do they want to pay for it?
No, it's funny. I heard something like when I was starting out, like businesses, the budget, X amount of percentage, some made up amount, but like a high amount, like they're more likely to be successful. And like watching it, I do actually sort of agree with that. Like,
why do you think it's the case? I have my ideas, but
yeah, it's sort of like it's like going to the gym or whatever. You set a goal and you achieve it, or at least you work towards it.
It holds you accountable.
Yeah. And if you don't have a goal, and this is with anything, like in gym's a good example, like or like it could be anything. Like
see, we haven't been held accountable with the gym stuff, have we?
Not at all, mate. But yeah, like literally, if you don't have a goal, you're not pushing towards it, right? So
it's like when people sign up for a marathon. Then they get out there training, running.
Correct.
Because they have something to train for.
Correct.
The budget is like training your mind to aim for something in the business.
Yeah, agree. And it's funny because we probably we've set all our goals internally in here and we've achieved all those. It's just
our budgets are very small though. Like revenue, profit.
Oh yeah. We're top down method sort of guys. Yeah. And then but it works.
It does.
But I guess if you work with it every day, you don't really need we don't need to iron it out like clients because we're so experienced in it. It's a bit different for us. But I think if you're not an accountant and you haven't been doing this for 20 years, like the two of us, you probably do need to put a proper budget in and check it.
With that, it's not just the numbers side either in terms of dollar value. It's like what drives the dollar value. So how many meetings, you can get to that granular, how many meetings, how many phone calls do I need to make every day?
Yeah.
That generates this amount of money, which generates this, for some jobs, they should go to that level.
100%.
What drives the revenue and then just focus on that. Because that's going to get you the end result.
Yeah, there's a lot of guys I watch and they say the action's more important than the outcome. So like, and that's what you should focus on. And they know that if you do that every day and you're not focusing on the outcome, that like you'll achieve it. It's like, so like I obviously do a lot of stuff with financial planners and things like that. And like with them, like their sales meetings, it's all about output. If you're doing a sales meeting, you know, once a week and you're talking about how many phone calls and what the pipeline's like, you always get sales. As soon as you stop doing the meetings and you're not talking about it, like that's when, you know, your new business might fail and all that sort of stuff. So yeah, I agree. Like you got to granularly break it down for a process and figure out exactly how many calls you're going to do and talk about it all the time. Then I guess like how do you monitor these things with clients? Like I do it with my clients as well, so we'll both go into it a bit. I guess time frames, like how often are you having meetings and talking about budget versus actuals?
Yeah, I think early on you want to do it like at least once a month.
Yeah.
But then like as the client understands the reports, understands the numbers more, it can push out to once a quarter. But I definitely like to do at least once a month.
Yeah, I think once a month with us to start with as a minimum, and then like when it pushes out to once a quarter, you want to be like the client should be at least checking it in between our meetings.
Absolutely, they got to understand it, and they got to be like, yeah, okay, I get it.
They should be checking it once a month regardless. Yeah, but then with us, it should be once a quarter as it pushes out. Yeah.
And what are we looking at in that situation as well? Like,
yeah, so I was going like, so how do you set the report up in that situation? Yeah, like, and you do a lot of my reporting for me, like as in like you'll set it up for me in terms of methods. Like how do you set it up to look at, you know,
I like to group like the expenses. So you there's going to be a detailed look at it. So every line of your profit and loss, you know, like rent and electricity and all the components of that. But to start with, we'd look at a grouped level. So occupancy costs would be grouped.
Yeah.
Employee costs would be grouped.
Yeah.
All the major items would be grouped.
Yeah.
And then we look at your percentages of revenue, what you should be hitting in your industry.
Yeah. So what are the ratios that you look at?
Like rent should be, for example, no more than 10% of your revenue.
This is for
restaurants, for example. Yeah. Like obviously for us.
For us, it's like 2%.
Yeah.
But yeah, correct.
Yeah. So it depends on the industry. So we'll look at like what those should be. For example, restaurants, like you want to be hitting your food cost should be say 25%.
Yeah.
To 27, that kind of area. Your bev should be 25 of your beverage sales. Your wages shouldn't be more than 40. I mean, even like 35 to 40 really max. Like, so we look at those and like how you're operating, and then you look further down at your operating costs, but they're kind of more fixed. So depends on the industry.
Yeah.
You know, like.
So like, yeah. So I guess in summary, like you look at other costs, like other being everything except for what I'm about to say. You'll do like a rental one, and then you'll do wages, right?
Yeah.
So like, and then each industry will have different ratios, but what you're looking at month by month is are the wages on budget, and then is the revenue on budget, and then what's the ratio of that?
Yeah.
Because it's pretty easy when you get in, like even for me, like all I really look at, to be completely fair, is like wages. Rental is rental. Like
we all know what you look at. Cash at the bank.
Cash, yeah. Cash is king. Yeah. But like when I'm going through reports with like all of the clients that I've got, wages is the number one thing, and it's always like how can you either pump revenue or reduce wages, and like wages is all in your control. So when you're looking at the performance, you know, like there's a nice guy tax when you keep people around who aren't doing stuff, or they're not like adding value to the business, or they're not adding monetary value. Everyone's got that like nice guy sort of thing, and like they're the businesses that I guess like the more upfront and honest you are with like getting a return on like the wages, the expense, you know, the owners will make more profit. Like, so when they're looking at things, but wages is the main ratio, I think, that like most of me and my clients look at.
Yeah, because a lot of yours are service businesses, and 100%. Wages are a big part of their costs. So it really depends on the industry. But obviously in Australia, if you got wages in Australia, that's going to be a big cost because wages are high.
Yeah.
So yeah, we'll definitely look at that. And then if your wages are too high, we'll look at then we'll go to the detail level on who is in the business if they want to get to that level, or they can go off and look at that and go, well, yeah, the owner needs to then go off and look at who's like get more detail on why it is that percentage and who's not performing, and then make decisions, either help them get better or let them go.
Yeah. And then so on top of these into different categories?
Yep.
Sorry, like, and what I mean by that is like a Sydney office, a Melbourne office, or like, you know, different offices or different restaurants, for example, if they're all under one entity. Do you ever split those out?
Yeah, so we look at tracking categories as well. You might have location, you might have restaurant, as you said. You can pretty much do you can have planner, like if it's a, you know, financial planning place, you might have per planner cost. Because it helps the owner get more detail on why, like who's performing well and where the things that need to be, like the things that need to be fixed. It gives them more detail on that.
Yeah.
For our business, we don't. We only have one location. We really only have one revenue line.
Yeah.
We do actually look at like CFO, tax, SMSF in our business.
Some other businesses.
So we do, but for clients, yeah, like it is important to understand, like you can go as detailed as you want. Those tracking categories may help you like with the answers to why your business is performing the way it is.
Yeah, okay. Yeah. All right, so I'll say there's two more things. What's like, this is just a question. Instead of your least favorite tax, which we were doing before, what's your favorite thing about budgeting? And I'll let you think about it while I answer mine. So mine's more like, you know, when you buy a lottery ticket and then you dream of winning the lotto, and like for like 15
I love how
minutes,
you've already spent it.
Yeah.
In your mind.
Yeah, in your mind, you already know what you're doing with it exactly. And like for me, that's what the budgeting can be. It's like, all right, if I do this year, I'm going to earn this much and I can buy a house here and do whatever. And for that little bit, I just love that about budgeting, because like you start setting targets and goals, and then as you achieve them, you're loving it. You know what I mean? What's your favorite thing about it?
Probably the accountability. Like, yeah, it's similar, but it's just, it holds you accountable and it gives you something to plan for. I think that's like it. You don't have to budget, but yeah, as you said, like if you don't have that goal of where you're going, like it just doesn't give you that drive necessarily to get there.
No, I agree.
Yeah.
So
but what something on the budgets that we haven't looked at is probably, and the reporting is actually what people often don't look at, and that's the balance sheet.
Yeah.
We probably need to touch on that, because obviously they're all, the profit and loss and balance sheet are linked. And so when we look at reporting, we do look at like your taxes that are coming up.
As well in the meetings.
Yeah, in the meetings. So it's like, it's important, like it's not just revenue and expenses. It's your assets and liabilities, planning on that. And yeah, so that's important to look at every month as well.
Yeah, agree. All right, so I think on that note, I'll leave just with like a famous quote, and we'll see everyone, I guess, next time for the next topic. So, failing to plan is planning to fail.
That's beautiful, Luke.
Thank you.